Hello and welcome back to JB Motivational, the channel where we empower you to make smarter financial choices and shape a brighter future. In today's video, we're diving deep into a topic that is more crucial than ever for young professionals in our rapidly changing economic landscape: financial literacy. In an era where financial complexities are at an all-time high, understanding how to manage your money effectively is not just an advantage, it's a necessity. We'll explore key personal finance strategies that will help you take control of your finances, avoid common pitfalls, and work towards achieving financial freedom. Whether you're just starting out or looking to refine your financial knowledge, this video is packed with valuable insights to guide you on your journey to financial empowerment. So grab a notebook, get comfortable, and let's embark on this important journey together. Financial literacy is more important than ever for young professionals starting out in today's complex economic landscape. Understanding key personal finance concepts can help lay the groundwork for future stability and success. This video provides an overview of essential money management strategies to help viewers take control of their finances and work towards achieving financial freedom. Why is financial literacy so critical in today's world? Costs for housing, healthcare, and education have skyrocketed, while real wages have stagnated. The days of rising salaries, affordable homes, and guaranteed pensions are gone. Student debt balances are at record highs, topping $1.7 trillion nationally. Credit card debt and other borrowing are also endemic. Medical bills can lead to bankruptcy. At the same time, Americans are woefully undersaved for retirement. Navigating these daunting economic realities and achieving lasting financial security requires knowledge, discipline, and a strategic approach. The days of winging it are over. Some sobering statistics reveal the urgent need for education. 64% of Americans do not have enough savings to cover a $1,000 emergency. 42% have less than $10,000 saved for retirement. 60% consistently carry credit card debt month to month. Without course correction, the next generation faces a perfect storm of economic hardship. What key personal finance concepts will be covered? Creating and sticking to a realistic budget, strategically paying down costly debt, building an emergency savings fund, automating investments, accessing workplace benefits, leveraging tax-advantaged accounts, and other fundamental building blocks of smart money management. Mastering these concepts early on and implementing enduring habits can lead to lifelong benefits. Chapter 1. Building a budget. Why budgeting matters. A budget is like a roadmap for your money, allowing you to track exactly where it is going. By categorizing every dollar earned and spent, you can align everyday spending decisions with your financial goals. Budgeting is essential for achieving healthy savings, managing debt, and funding retirement accounts. It provides visibility into expenses and empowers intentional choices. Creating a budget. The first step is to list out all predictable sources of income on a monthly basis. Next, comprehensively categorize expenses into two buckets: fixed essential expenses like rent, car payments, insurance premiums; flexible lifestyle expenses like dining, entertainment, clothing. Be honest and thorough when documenting where your money goes each month. Every coffee, ride-share trip, and Amazon order must be accounted for in your cash flow. Once these predictable income and spending streams are mapped out, you can compare estimated totals monthly. Are you consistently spending more than you earn? Or does your budget reveal room to build savings and invest? Following the 50-30-20 budget guide. The 50-30-20 guideline recommends dividing after-tax monthly take-home income as follows: 50% on essentials like housing, food, transportation; 30% on flexible lifestyle expenses; 20% on financial priorities like debt payments and retirement savings. For example, an individual earning $5,000 monthly would aim to reserve $2,500 for essentials, $1,500 for flexible spending, and $1,000 for financial priorities. Tailor exact percentages to your unique situation, but this provides a simple, sensible framework, strengthening financial foundations. Using budgeting tools. Spreadsheets or budgeting apps can automate tracking and analyze spending patterns over time. Mint, you need a budget. NAB, and every dollar are popular choices integrating with bank accounts to sync transactions. Look for a program that pulls all financial information into one place and provides user-friendly money management features like customizable categories, notification alerts, budget versus actual spending reports, and charts. Find one that works best for your habits and preference. Sticking to your budget. Once the budget is set each month, consistency and accountability are critical. Avoid budget blowouts from lifestyle inflation or unplanned splurges which can quickly snowball. Celebrate milestones like fully funding an emergency savings account or paying off a credit card. Instill budgeting as an enduring habit and the gateway to financial freedom. Monitor, assess, and revise each month to account for changing circumstances over time. Chapter 2. Managing Debt. Taking stock of liabilities. Debt is a growing burden for millions of Americans today. From credit cards to auto loans to towering education debts, obligations can easily spiral if not strategically managed. To formulate a paydown plan, first compile a list all debts owed with corresponding balances and interest rates. This summary provides visibility into total money owed, so you can target the most pressing liabilities. Typical debts may include student loans, average balance $30,000 plus. Auto loans, average rate 4 to 6%. Credit cards, average rate 14 to 17% variable. Personal loans, average rate 10 to 28%. Aim to eliminate debts charging higher rates first before the balance can balloon. Paying off high-interest credit card debt. Credit cards have notoriously high interest rates, commonly within the 14 to 17% range, causing debt balances to quickly snowball. These should be the priority focus for debt reduction tactics. Two popular strategies include the debt avalanche method. Pay minimums on all debts while aggressively tackling the card charging the highest interest rate first. Once that balance hits zero, roll that payment amount into the card with the next highest rate, creating an ongoing avalanche effect. This mathematically minimizes total interest paid over time. The debt snowball method. Pay minimums on all but the card with the lowest overall balance first, while aggressively paying that one down. Eliminate the small balance cards one by one to build early wins and stay motivated long term. Though less efficient, this offers emotional dividends. Automate payments each month for momentum. Once credit cards are paid off, channel energy and higher monthly cash flow towards the next priority liability. Refinancing and consolidating student loans. For those carrying education debt, multiple student loans can be consolidated together into one new loan with a lower fixed interest rate through a private lender. This reduces the monthly burden, freeing up cash flow for other goals. Refinancing rates vary from 2 to 8% fixed based on credit, income, and other factors. Alternatively, federal loans can be consolidated but may offer fewer repayment protections. Always run the numbers to understand trade-offs. Chapter 3. Building an emergency fund. Why it matters. Savings provides a crucial financial cushion and stability during unexpected crises like job loss or medical issues. About 64% of Americans do not have enough to cover a $1,000 emergency expense, which can quickly spiral into high-interest debt without cash reserves. Prioritizing an emergency fund early on prevents this destabilizing reactionary cycle. Size guidelines. Experts recommend having 3 to 6 months' worth of average living expenses set aside, equivalent to 25 to 50% of annual spending. This funds essential costs if primary income is disrupted. Calculate your average monthly expenditures for necessities like housing, transportation, food, utilities, and multiply by 3 per 6 to set your target emergency savings goal. Setting up automatic deposits. One highly effective strategy is automating transfers from each paycheck so that savings contributions happen seamlessly in the background of everyday spending. Start small if needed, even $20.50 per pay period. This recurring set-it-and-forget-it approach allows the balance to silently accumulate over time to build a robust rainy day fund amount. Account to park cash. Keep emergency money accessible in an FDIC-insured high-yield savings account, not invested in the market. High-yield savings offer over 20 times the interest rates of a traditional checking account to passively grow the money, while still allowing easy access to withdraw funds anytime if an urgent need unexpectedly crops up. Gaining fundamental personal finance literacy around budgeting, strategic debt management, and establishing cash reserves provides a basis for stability and success for any young professional starting out today. Mastering money management leads to being intentional with every dollar, rather than reactionary across working years rife with competing financial priorities. Diligently implementing basic building blocks covered equips one to firmly put their finances on the road to lifelong security, resilience, and control. This journey requires patience and perseverance in equal measure to common temptation and uncertainty. But the rewards for financial fluency are invaluable both today and into the future. Closing remarks. The time is now for the next generation of professionals to seize control and change the narrative around money by taking consistent action. Financial literacy unlocks life-changing options and opportunities, otherwise obscured by debt burdens and economic instability. Commit to the small daily choices that transform futures. Monitoring spending awareness, automating savings, pursuing education options, leveraging workplace benefits, harvesting market returns. Channel ambition into financial betterment instead of status consumption. Build the foundation today, brick by brick, to open up capital capacity for investing in yourself, your family, and purposeful dreams, whatever they may be. This work fuels lasting personal freedom to pursue more in career, leisure, philanthropy, and beyond. Your future wealth begins now. Start where you can. Start small if you must, but start. And that brings us to the end of our comprehensive guide on financial literacy for young professionals. Thank you for joining me here at JB Motivational. Remember, the journey to financial freedom isn't an overnight sprint, but a marathon requiring patience, discipline, and continuous learning. By implementing the strategies we've discussed today, you're not just making smart money moves. You're building a foundation for long-term success and stability. Financial literacy is the key that unlocks doors to opportunities, enabling you to make informed decisions and take control of your financial destiny. As you continue this journey, remember to start where you are, use what you have, and do what you can. Your financial future is in your hands, and every small step counts. Stay motivated, stay informed, and let's build a brighter financial future together. Until next time, keep pushing forward, and don't forget to like, share, and subscribe to JB Motivational for more empowering content. See you in the next video.